It's the final one for the week. It's 1:30 p.m. Time for Business Incorporated. You're welcome. This is what we have for you on the program today. South Africa and companies from China have sealed a deal of over $2 billion. And back here in Nigeria, the Central Bank of Nigeria released its financial statement first time in 7 years. Kenyans are groaning under the high cost of living as the shilling loses more value. Good afternoon once again. I'm Ini John Mekwa. This is Business Incorporated. We get straight into the numbers of the day and we look at some positive sentiment or more negative on the African continent. Starting with Nigeria, recovery there sustaining the bullish sentiment it closed with yesterday. There you have the number, 0.15%, still sustaining the 65,304.44. It's the flip side for South Africa, 0.52%. in the red. Egypt is closed today, Friday, 0.30%. It closed in the red at 17,710.20. Kenya, this is Thursday's closing number, 0.69% in the red. A loss that's 105 now settled at 104.33. Let's head straight up to the Middle East and see there, well, two of those markets are closed on Fridays, but we see Abu Dhabi, which is open today, 0.15% in the red. Intraday Dubai is 0.16% in the green, and those close are Saudi Arabia, close positive 1.22%. Qatar also closed positive 0.18% on Thursday. Let's head to Berlin now and tell you what's going on there. Well, we can tell you that from Germany, Chiponda is standing by to say that after President Biden's administration moved to ban United States investments in 3 key areas of Chinese tech, the EU is now holding off following suit. For now, let's find out why with Chiponda. Hi, Chiponda. Good afternoon. So tell us more about this plan and why the EU is holding off.
Well, this decision didn't come as a surprise for EU officials. Their U.S. counterparts have been speaking about them, about this with them, and of course the plans to restrict U.S. investment in Chinese technology. The restrictions will affect investment in quantum computing, advanced chips, and artificial intelligence technologies from next year. And any U.S. citizens and permanent residents will be banned from activity in those areas, even if they are working outside the U.S. for a foreign company. Now, that is what we know so far. There's still some details that need to be ironed out, and the time between now and when the ban takes effect will be used to provide more details. Officials in Brussels already knew this was coming because they had been informed by their peers in the U.S. who had also spoken to Beijing about this prior to the announcement. So the policymakers of the biggest economies have had some time to consider the impact that this will have.
So how will this affect businesses?
Well, the experts are saying that this will have no major impact on the investment strategies of EU businesses. The biggest impact that this new restriction will have is related to U.S. citizens and permanent residents for now, who, of course, will be restricted from working in the banned area. Now, that's something that European multinationals in particular will have to consider because it could implicate their employees. But there's, of course, also a lack of clarity about how exactly that particular restriction will be applied and also monitored by U.S. authorities. For now, EU businesses are probably more concerned about the proposal that the EU itself is working on. And experts say that the U.S. ban could serve as a blueprint. But it is unlikely that Brussels could copy it entirely. That's, of course, because of how economies in Europe are intertwined with the Chinese economy. For instance, China is Germany's largest trade partner, and it is an export-dependent economy. any similar bans could potentially have a bigger impact on European economies than the US. So some EU governments aren't very keen on imposing restrictions that would negatively affect businesses here. Experts expect also geopolitics to play a major role in shaping the proposal on restrictions on investment in China that we may see from Brussels. So the EU proposal for restrictions could potentially align closer to Washington because, of course, the bloc wants to also reduce its dependence on China.
I wonder how this is affecting the markets.
Well, European markets are expected to trade lower. Now, traders will be taking cues from Asian markets and Wall Street. Despite the relief we saw from the latest U.S. inflation data, investors are concerned about the economic outlook for the world's largest economy, and that is outweighing hopes that the U.S. Fed will pause interest rate hikes next month. The markets will also be looking to China with some concern. Another property giant there, Country Garden, has signaled liquidity concerns. Now that's going to raise concerns about the health of the wider Chinese economy. And of course, a slowdown in the Chinese economy has already been affecting European businesses and, of course, the global economy.
Chip, thank you so much and have a great weekend. All right, talking about China, let's go to Asia markets, and we see that markets displayed a mixed perspective on Friday. The driving force behind this was notably reduction in inflation rates within the United States, as this unexpected reduction raised hopes that markets could be steering towards a soft landing in the ongoing battle against inflation. Let's look at the numbers in details now. The Nikkei 225 has been in the green again, almost all through this week, 0.84% at 32,473.65. The Kospi is on the flip side, almost 0.5% in the red, 2,591.26. Hang Seng Index, even more negative, 0.90%. If we can see the others now, Shanghai, 2% in the red, and Australia are still trying to recover, 0.24% in the red. In the United States, now we see that Dow Jones Industrial Average traded near flat on Friday as the futures, as traders awaited wholesome prices data and moreover July's CPI, which was released yesterday. Futures linked to the blue chip index. Looking at the numbers right there, the Dow Jones is positive 0.03%, very marginal. There's 35,263. S&P 500 on the flip side, 0.06%. at 4,483. NASDAQ at 0.17% in the red at 15,173.75. But that yesterday was when the CPI was announced. Let's see if the market was able to capture and react to those numbers. Maria Bird reports.
The U.S. stock market was nearly unchanged on Thursday, as the Dow Jones was up at 0.12%, the S&P 500 just slightly at 0.03%, and the heavy tech Nasdaq up at 0.15%. Many investors were watching to see how the July inflation report that was released on Wednesday would impact the economy. But the Federal Reserve seems to be still confident despite the fact that inflation showed a bit higher for the month of July. This was mainly due to areas of food and oil, which are outside of the core price indexes. This also shows that the U.S. economy is going in an upward swing, as the core indexes were not up much farther than the month of June, the lowest we've seen since 2021. This has investors confident that we will not see many interest rate hikes over the next days and weeks ahead. The Federal Reserve seems to be very comfortable, which makes investors very comfortable that we could potentially see an upward swing in a positive direction for the U.S. economy.
Thank you so much, Maria. Let's go to the global oil space now. Prices saw a marginal decline as market participants weigh the positive demand projections from the OPEC producer group against the backdrop of mixed economic indicators from China, which is the world's top importer. Brent crude, a global benchmark for oil prices, retreated by 25 cents, settling at $86.15 a barrel. Simultaneously, U.S. West Texas Intermediate crude futures experienced a dip of 25 cents, closing at $82.57 a barrel. Both benchmarks have been on sustained rally since June. Just a day before, WTI had achieved its highest price point of the year, while Brent reached its best price since January. The Organization of Petroleum Exporting Countries, OPEC, declared that it expects global oil demand to increase by 2.25 million barrels per day in 2024. This projection remains consistent with the growth of 2.44 million barrels projected for 2023. Both figures remained unchanged from the previous month, and OPEC report also highlights potential for solid economic growth, particularly spurred by continued improvement in China, which could drive oil consumption in the coming year. U.S. consumer price data for July, which fueled speculation that the Federal Reserve might be approaching the conclusion of its aggressive rate hike cycle, however, points out that sluggish economic data from China and Wall Street retreat had weighed on risk sentiment. Metals now. Gold prices held near one-month low on Friday, shrugging off cooler than expected U.S. inflation figures for last month, with bullion staying on course to wrap up its worst week in 7 as the U.S. dollar and bond yields stood strong. In the current market, spot gold edged 0.3% higher to $1,917.89 per ounce, but traded near its lowest level since July 7th. It touched earlier in the day. U.S. gold futures were steady at $1,950. We go to South Africa now, where some deals are being sealed. Companies from South Africa and China concluded trade deals worth $2.19 billion during a visit to the country by the Chinese Commerce Minister Wang Wentao. The agreements were made at a meeting of a joint economic and trade committee aimed at boosting South African manufacturing exports to China and Chinese investments in the southern African country. South Africa's trade industry and competition minister told journalists that this was all on the works at this time, and they look for a concluding part.
The total two-way trade between China and South Africa has exceeded 900 billion rand. That South Africa's exports to China exceeds 500 billion rand. And that represents a success in the first phase of our relationship, which was deepening trade relationships after the re-establishment of political relations in 1994. The second phase of our relationship has been to deepen investment, to get more inward investment by Chinese companies into the South African economy and by South African companies into the Chinese economy. And I reminded my team that what this was doing, it was re-establishing a connection that there was between what is today's China, but it was then the Song dynasty, and today's South Africa, which was then the kingdom of Mapungubwe. And more than 1,000 years ago, they traded with each other. And so as we deepen our trade, we look to doing more things together. We've come up with an action plan, and for 6 months we're going to be working very, very hard. For the companies that are here today, there are many companies from both China and South Africa. We wish you well in the commercial relationship. We know that the agreements that will be signed today equals about $2 billion, and that makes it a significant support for South African-based companies.
And back here to the western part of the continent, economic stability may be the long-term solution to the coup in Niger and other parts of West African region. This is a suggestion of international trade and relations expert Mr. Felix Obi. If ECOWAS focuses on this, members will have more incentive to be active in the union. Mr. Felix Obi was a guest on Business Morning earlier today.
If, in especially French West African countries, the economic relationship between the countries and France is unequal and not meeting the aspirations of the people, The leadership of the sub-region has a responsibility to advocate for a better deal. And at this major inflection point, with the state of coups in West Africa, at this major inflection point in the broader global context, where the transatlantic alliance is looking to de-risk this international global supply chain, President Tinubu has a unique opportunity to advocate for the location of industries in the continent, in Nigeria especially, and the sub-region, of course, as part of the transatlantic alliance's de-risking of supply chains. This is how you make ECOWAS more attractive to.
Welcome back to Business Incorporated here on Channels Television. Let's head straight to Eastern Africa, where the Kenyan shilling has, in one of the costliest free falls in history, lost its value, trading against the US dollar by nearly half in under 50 months. And that makes consumers pay dearly for imported goods. Several commercial banks are already selling US dollars above the 150 shillings mark in Nairobi, piling pressure on the Kenyan shilling while setting up consumers for a new wave of currency-driven price increases across imported products, including fertilizers, electronics, and cars. We have Matt Kindiga now joining us from London, practice leader, Sub-Saharan Africa, front of you, to tell us what else he knows about what's going on, especially with Kenyans and their shilling. So, Matt, good afternoon. What's your forecast for the shilling over the coming months?
Hi, good afternoon. Thanks for having me on the show. So, our base case view is that the shilling remains overvalued at the official rate. Our view is therefore that the shilling will continue to lose value, and we are expecting it to exceed 150 per dollar at the official rate by the end of this year. And this means effectively that the central bank is going to continue to allow a steady depreciation of the currency. It's currently hovering at about 143 per dollar at the official rate. So we are going to see more depreciation, and this is really being driven by slumping sentiment towards the country around, weaker public finances, but also because we're seeing strength in the dollar. The US Federal Reserve, the Bank of England have raised interest rates recently. And although the Kenyan central bank has done so as well, we haven't seen them raise interest rates quite as quickly. Our view, however, is that in 2024, the pace of depreciation will slow, and we are expecting the shilling to stabilize somewhat at around about 150, maybe 155 per dollar. And this is because we are expecting the economy to improve a little bit, interest rates in the US to begin falling, and also because tourism revenues are probably going to pick up in Kenya next year. So a bit more depreciation followed by a stabilization next year.
Well, a lot of African countries are expected to stabilize next year. I hope they can survive until then. But, I mean, in this wave of imported goods, of course, costing much more than it used to, what's happening to businesses? Perhaps there are some businesses that deal with imported goods that are cashing in on this.
Yes, well, I mean, the biggest impact that, most of our multinational clients that we advise operating in Kenya and also some local businesses are saying is that this creates massive uncertainty for them because, 6 months ago, a year ago, they were budgeting for 120 per dollar, perhaps in a worst case scenario, or 130. But now we're facing a world where the shilling is going to be 150 per dollar very soon. This creates massive planning problems. It's also very inflationary, as you mentioned. Goods being imported into the country are rising in price, and this is squeezing margins quite significantly. And the problem is that this is being compounded by the fact that the country's economic growth is slowing. So you're facing rising costs and slowing economic growth and slowing demand. So a real bind for many companies. But also we are seeing forex shortages. So foreign currency shortages are a problem in Kenya. But the silver lining here is that as the currency depreciates, we are expecting forex shortages to get a little bit better. So there to be a little bit less pressure on foreign currency availability at the official rate at least. So although it is quite a difficult environment as a result of higher costs because of the depreciation, it does mean that we're probably going to see fewer foreign currency shortages going forwards.
And what can we expect the central bank there to do?
So our view is that the central bank will certainly raise interest rates. It has been raising interest rates, not quite as quickly as other markets globally. But we are expecting more interest rate hikes. Our view is that if the central bank wants to allow the shilling to return to more of a free float, so at the moment it really is it's controlling the pace of depreciation very heavily through interventions into the forex market. If it wants to allow a free float, the interest rates in Kenya need to rise relatively substantially. So we are expecting to see more interest rate hikes come in Kenya, although we probably have to wait until social unrest in the country subsides first. There are also a couple of other things the central bank can do. It can provide commitment, or it can help or encourage the central government to ensure that it is committed to helping the country's public finances stabilize. So investors, if they want to become a bit more confident in Kenya and also make sure that the shilling is a bit more stable, we do need to see very firm commitments from the central government that they are looking to stabilize public finances, introduce painful but necessary austerity measures over the coming months. So certainly a few things that the authorities could do over the next few months to stabilize the shilling.
Yeah, unfortunately, this is the story of a lot of African countries at this time, the shortage of FX and the need to take some tight and harsh austerity decisions. But thank you so much, Matt Kindiga, for your perspective this afternoon, and do have a great weekend.
Thanks, you too.
Talking about central banks in Nigeria, the Central Bank of Nigeria has released the consolidated financial statement for the first time in 7 years. Well, the group and bank's profit for the year was 103.854 billion for the group, or 65.626 billion for the central bank itself. Well, 2021, it stood at 75.125 billion for the group and 31 billion for the bank. And this indicates an increase of about 38 billion from a year earlier. In line with the provisions of the Fiscal Responsibility Act 2011, 20% of the net income of the bank will be credited to retained earnings, while the balance will be paid to the federal government of Nigeria. Total operating income for 2022 stood at 2.2 billion naira from 1.78 billion naira in 2021. The Apex Bank, however, stated that it owes Goldman Sachs $500 million and JP Morgan $7 billion in what it classified as securities lending. Securities lending forms part of the CBN's total external reserves of about 14.3 trillion naira or $29 billion using the official exchange rate as at then. We go to Egypt, where the Citigroup Incorporated is paring back its optimistic view on Egyptian bonds on concerns over the cash-strapped nation's slow progress in selling state assets. Strategists at the New York-based bank said that they reduced their overnight call on Egyptian debt, saying that the nation's privatization plan is increasingly falling behind targets. The International Monetary Fund has said that it is waiting to privatize deals for state assets and genuine flexibility in Egypt's currency before carrying out the first review of a $3 billion rescue program. Last week, Egypt's sovereign dollar bonds rallied higher following a surprise interest rate hike the previous day. Longer-dated maturities gained the most, with 2048 rising up to 1.4 cents. TradeWeb data shows, and bonds maturing 2040 and beyond gained 1 cent or more. But the shorter dated maturities up until 2031 rose between 0.5% and 0.9 cents. That's it for Business Incorporated for today and the week. Thank you so much for being a part of it. Tomorrow, 7 p.m., Will Ibong will be up for Capital Market, and she'll be giving you a summary, the high points of the market for the week. I'll see you on Monday for Business Morning. Do have a great weekend.